All right, let's take a look at master budgets and planning. You know, when we think about managerial accounting, if we go back to chapter 14, you'll remember that I told you that managerial accounting is all about planning and control. And just saying the word budgeting really implies a plan, right? If you think about what a budget is, it's a plan about something to come in the future. And that was also a major difference of managerial accounting versus financial accounting, is that managerial accounting often looks to the future, whereas financial accounting almost always looks at the past. So let's just talk about some of the benefits of budgeting. Enhances coordination so that activities of all units contribute to meeting the company's overall goal. What in the world does that mean? Well, if you're talking about a department store, if you think about that, making sure that all of those departments are coming together, they're talking about what has to happen, what needs to happen, and looking at the company overall. Straight down motivates employees through participation in the budgeting process. Absolutely. The budgeting process, as you'll see here soon, is a bottom-up process. It should never be top-down. So employees have to get involved. They need to be active in letting management know what their needs are and what their thoughts are for the good of the organization. Up at the upper left, providing a benchmark for evaluating performance. And that is really just one of the things that has to happen in a budget, or one of the things that is truly the most important part of the budget, is the ability to evaluate and control what happens. The budget is a plan. Well, it doesn't do any good if you're just going to stick the budget on the refrigerator at home and let it just be a piece of artwork. It doesn't do any good if you never go back and see where you are in relation to your budget. Upper right says promotes analysis and a focus on the future. Again, a budget is a plan about the future. So rather than just taking a guess every once in a while, you can actually write it down and start to focus in on things. Lower right communicates management plans throughout the organization, and that kind of goes up there with the top one. Now everybody can see it because it's written. And lower left converts long-term strategic plans into short-term financial plans. It can be really hard without a written plan to think long term and then to really take action on it. But when you write down a plan and you say, here's our short term goals, here's our long term goals, you can start to take action on them because you can see them. Lots of benefits to budgeting. You'll see that warning down there. If not properly applied, budgets can have a negative effect. Here's the truth of the matter, folks, is that everyone is an optimist when it comes to their money. Everybody thinks that they can sell more than absolutely possible, and everybody thinks that they're going to do just the best job ever of controlling cost and cutting cost. It just doesn't work that way. The real world doesn't work that way. But budgets need to be realistic. In fact, you need to make sure that what you plan to sell is what the market demands and is what you can truly produce. You need to make sure that when you do that budget, that the expenses on that budget are fair and reasonable, that you've not tried to cut corners on the budget, because you really just don't do yourself any favors. Budget reporting and timing. Typically, budgets are created annually, and then they're just divided back by months. So typically, if you're going to create a budget, for 2019 at this point, because I'm currently doing this in June of 2018 is when I'm recording this lecture. If you're doing a budget for 2019, you're most likely just going to look at the whole year of 2019 and then try to break that down into monthly components. You'll see there at the bottom left there, that dark blue box, a continuous or rolling budget is a 12-month budget that rolls forward 1 month as a current month is completed. And I would say that really most of the businesses I work with deal with rolling budgets, and it's because they're small businesses. These budgets they're not really all that complicated. It's not that hard to figure out and to really focus on what's happening. Yet you'll see over here that this graphic says that only about 45% of companies using budgets use rolling budgets. And I think it's really just the difference between large business and small business. My business certainly uses a rolling budget month to month. Again, I already said this a minute ago, the flow of budget data is a bottom-up process. It never should be top-down. Top management rarely really knows what's happening out on the floor or department by department. So it really should be a bottom-up process. A budget committee in a larger organization is responsible for making policies and for coordinating efforts for all participants. I think that it really helps to keep the budget process itself quite realistic because you've got everybody from all of the departments talking about the organization as a whole. I can guarantee you that the person sitting on one side of the table from the automotive department would probably have something to say from the person from menswear if the person from menswear is being a little bit too optimistic. Not only that, they're all kind of vying and grasping for a little bit more money for their department so they can do something different. So they all really have to get together to coordinate it. I'll tell you that budget committee meetings sometimes can get a little bit choppy. People get angry. It really takes a strong-minded person to get in there and talk about what they need in their department and why they think that's going to do well for the organization as a whole. And very often, the people in these budget committees really have an accounting background. All right, so what we're going to talk about in this lesson is the master budget. So I want you to just get a little bit visual here with me for a second. And I want you to think just about a big 3-ring binder, big old 3-inch 3-ring binder. And on the front of that binder, it says master budget. What you should already be thinking is that, okay, if I've got a really big, thick 3-ring binder and on the front it says master budget, there must be some pieces and parts to this budget. And you would be absolutely right in that thought. So inside that 3-ring binder may be several divider tabs, and those divider tabs are really going to be titled as sales, production, and then under production we'll have some sub-tabs for direct material, direct labor, and factory overhead. Then we'll have a cash budget tab, we'll have a capitals expenditures tab, a selling and general administrative expenses tab, and actually the cash one's probably going to be last in this master budget. But we have to go through all of these pieces and parts. We're going to talk about the operating budget first. And all of the components of the operating budget, the sales budget is absolutely the first one that must be completed. Most people, even in their personal lives, when they create a budget, they sit down and they think about what all their expenses are, and they write down all of their expenses, and then they look and say, okay, do I make enough money to afford all of this? And that's because in our personal lives, most of us live on a fixed income. If you make a salary and you're not working hourly, you don't have any kind of side work, if you're a salaried employee, you have a very fixed income. You know what it is, so you don't think about sales budget. But we're talking about a company here. You really have to start with the sales budget because you need to plan what your unit sales and what the expected dollar amount from those sales are going to be. You don't just pull this stuff out of thin air either. That becomes a problem for a lot of companies. They just pull stuff out of thin air and say, oh, I think I'm going to sell $100,000 worth. No. We don't do it that way. There needs to be some market research and analysis of economic and market decisions, forecasts of customer needs. You need to do some research and development, without a doubt, to find out how much you can truly sell and if you can meet that capacity. Once you do that research, you can come up with estimated unit sales and an estimated unit price. From that, you create your sales budget. We're going to use Toronto Sticks Company, or TSC for short, throughout the remainder of this lesson, just to show you all of the pieces and parts of the budget process. So we're going to start out with the sales budget for TSC. And it says in September 2015, they sold 700 hockey sticks at $60 each. And because of that, so basically that was the end of the third quarter, right? So we're going into the fourth quarter, and they're going to prepare a budget for the next 3 months, October through December. And here's what it is. So they've done some research. See, after considering sales predictions and market conditions, they prepare a sales budget for the next 3 months. They believe that they can sell 1,000 units in October, 800 in November, 1,400 in December, 3,200 for the quarter. $60 each is what they sell for, and then you'll see the dollar amounts that they'll have in sales for each of those 3 months. It's that simple. The hardest part of all this is doing the research and development to figure out exactly what you think you can sell. Does it make sense that a hockey stick company would have this kind of fluctuation in unit sales in the final quarter? And I think so. Here in October, it looks like it went up some from September. It said that they had sold 700 hockey sticks, and now in October they think 1,000. Why did it go up? Well, hockey season's beginning, right? So I think that's right. November, hockey season ends, it kind of goes down, and then all of a sudden it's way up in December. Why in the world would it be up in December? Well, the holidays. People are out buying Christmas gifts for all their kids and everybody else who likes hockey, right? So things are going to be a little bit higher in December. So it makes sense. From after the sales budget, we're going to go and we're going to start preparing the pieces of the production budget. Notice this here. In the production budget, it's going to show the number of units to be produced in a period. The production budget is really going to just get us down to the quantity that we need first, right? That's what the production budget's going to do. How many units do we need to produce? And then we'll get into the dollars that we have to deal with. And that it's going to be based on the unit sales projected in the sales budget. We've seen this before. Ending inventory, this is all about inventory. Ending inventory plus budgeted sales for the period is going to equal the required units needed for the period minus the number of units in beginning inventory to get us the total units to be produced in the period. Let's just think about that one more time. So, how much do I want to have in my ending inventory at the end of the month? Plus, how much am I going to sell this month? That kind of tells me how many units I have to have this period. So if I want to end October with 10 sticks, but I think I'm going to sell 20 in the month, I want to end with 10, but I think I'm going to sell 20 in the month, then I'd better have 30 available, right? Well, I probably already had some, right? Let's say I already had 5 in inventory, right? And that would mean that I would need to produce 25 this period. You'll see that the production budget does not show cost, only units of product. Let's see what's happening. So TSC says that they always want to have in ending inventory 90% of next month's expected unit sales. Now, they just kind of throw this slide out here and don't really tell us where this comes from. They just don't. Okay, so we kind of had to figure it out ourselves. But look at what they're saying. Next month's budgeted sales. This is October. Next month's budgeted sales from the sales budget. Well, if we looked back at the sales budget, 800 was what they expected to sell in November. But TSC wants to have 90% of what's going to be sold in November available by the time they finish up October, right? That makes sense. You don't want to go into November with nothing available for sale. So they want 90% of next month's sales available when they end October. But if you look again back at the sales budget, we plan to sell 1,000 in October, okay? So let's reiterate. I plan to sell 1,000 in October, and I want 720 left over at the end to go into November with, okay? That means that I need to have 1,720 on hand throughout this month. Okay, I get that. But we already had 1,010 beginning inventory units. So we have to be given this number, and it says that it's inconsistent with company policy. So there was a problem, but they didn't give us any more information other than this number. But what it tells us is that this is what's required, and this is what we already had, then I need to produce 710 in October. Let's just go over November. We won't get so detailed about December. Our December sales forecast is going to be 1,400. So if I take 90% of that, I need to have in November's ending inventory 1,260. I plan to sell 800 in November. That's a requirement of 2,060, but I should have had 720 coming over from October. Therefore, I need to produce 1,340. So there's kind of this rolling concept going on here. You have to think about it. You can't just take the sales and say, oh, that's what I got to produce, because you've got to take other things into account. Now I know how many units need to be produced each month. Well, this is a production budget. Do you remember the types of cost that are in product cost? Hopefully you said direct material, direct labor, and overhead. Well, if this is the production budget and I need to get to cost, I think I'm probably going to take the number of units to be produced times some unit price for each of those things. Let's look first at the direct material budget. Basically what's going to happen now, here's my budget production units for October, November, December. We just figured this out, and apparently we need about a half a pound of something per unit in order to create a hockey stick. We need, I guess maybe it's carbon fiber or wood, or I don't know, but it's either half a pound or half a kilogram. I don't know exactly what it is. I think it's, I don't know, who knows. So in October, I need 355 pounds, it's half a pound. 670 pounds in November, 475 pounds in December, but again, I don't want to end October without some ending inventory. I've got to have some material to take me into November. I've got to have some material to take me into December. So they've come up with this somehow. They don't tell us how. So I have a requirement of 690 pounds. I already had beginning inventory, so I need to purchase 512 pounds of material. Okay, how much do I pay for it? I pay $20 per pound. Therefore, my cost for direct material in October is going to be $10,240, $11,450 in November, and $9,700 in December. I now have a direct material budget. Again, where did this all stem from? It stemmed from the sales budget. From the sales budget, I created the production budget based on my policy, and now from the production budget, knowing what I have to produce, I figure out how much material I need and how much that material costs. All right, what about the direct labor budget? It looks like we spend about a quarter of an hour to produce every hockey stick. Again, I need to produce 710, 1,340, and 950 in each of these months at a quarter hour each. Tells us how many labor hours are needed, and it looks like we pay our people $12 an hour. Therefore, I now have a labor budget, direct labor budget for Toronto Sticks Company for the quarter. And then we get into factory overhead, and it looks like our variable factory overhead rate is $250 per, I guess it looks like it's per unit. They went ahead and gave us that. And then we have a fixed overhead. So we just have a variable factory overhead rate per unit. It's not by the hour, right? $250 per unit fixed overhead, and now we have our budgeted total overhead. Pretty simple. Okay, so with the information from those three things, direct material, labor, and factory overhead, we can compute the product cost per unit. Okay, and that's nice, and this is for full absorption costing. So we're going to assume that we would normally produce 3,000 units of product each quarter. That's just our application. Yields fixed overhead of $1.50 per unit. See, remember that $1,500 per month, that's $4,500 for the quarter. And if we do 3,000 units per quarter, that's going to break out to about $1.50 per unit. So if we had to do cost of goods sold, because it's under absorption costing, we would figure cost of goods sold to be $17 per unit. Then we get out of the production budgets, and now we're in what we call the selling and the G&A budget for general administrative expense. The selling expense budget is basically just an estimate of types and amounts of selling expenses. It says that we pay sales commissions equal to 10% of total sales, okay, and we pay a monthly salary of $2,000 to our manager. So let's do the selling expense budget. Should be pretty easy. We know budgeted sales. We can go get this from the sales budget. And if we pay a 10% commission to our selling employees, we can work that out, $6,000, $4,800, and $8,400. And then we pay a sales manager $2,000 per month. So now we have a selling expenses budget. Again, pretty straightforward. We get to the G&A budget, it's even easier because general administrative expenses are usually all fixed. It says that we pay G&A salaries of $54,000 per year. That equals $4,500 a month. So here's the entire budget for G&A. It's administrative salaries, $4,500 a month, or $13,500 per quarter. All right, even simpler is going to be the capital expenditures budget. Remember, capital expenditures are the purchase of big things, right? If we're going to buy some big machine, excavator, big copier, it doesn't happen very often because these are really, really big expenses. So this budget's even simple. We don't even write it down. We don't anticipate the disposal of any assets, but we do plan to acquire equipment for $25,000. And since it's the only thing we're not even going to show a separate budget. We'll indicate it in a future budget. You'll see it in the cash budget. All right, so with all of that done, we get to really what most people would think the master budget's really about. It kind of brings everything together, because after we develop all of these individual budgets, we use all these pieces and parts to create the cash budget, which shows us the expected inflows and outflows during the budget period. The cash budget is by far the most important budget to management, because they want to make sure that they're going to have enough money to operate at the end of each month. Very, very, very important. You can do all those other budgets till you're blue in the face, but the cash budget is important, because cash is king, and without enough cash in the bank, we're not going to stay in business. All right. So let's see. So the general formula for a cash budget. Let's just think this through for a second. I know it looks a little crazy. Usually we're going to start each month with a beginning cash balance. I hope so, because if not, we're already broke. We're going to add in any cash receipts from customers, right? This is going to be money coming in from customers, and we're going to take away any cash that we spent. Well, that makes sense, right? Whatever money I had in the bank, plus the deposits I make at the bank, minus any checks that I wrote, equals my cash balance. Why is it a preliminary cash balance? Because most big companies, and not even so big, I have the same type of arrangement set up with my bank, is that if my cash balance falls below a certain threshold, my bank is automatically going to pull money from a line of credit and put it in my bank account. And if my cash balance is above that threshold and I owe money on my line of credit, then part of that money is going to be used to pay my line of credit until I come back down to the threshold. You'll see this in just a second, without a doubt. We've got to understand some things about cash movements. We can't just say that cash receipts is going to be all of October sales in October, and all of November sales in November, and all of December sales in December. Why? Because we sell stuff on credit, and people don't pay us right away. That's just the nature of business. So what happens with TSC? It looks like 40% of the current month's sales are for cash, and the remaining 60% is going to come in the following month. So in October, I'm going to receive 40% of October sales, but then I'm going to get 60% of September sales in October. The remainder of October sales I'm going to get in November. It's easier to see when we look at the graph. Here it is. In September, we sold 42,000. 60% of that was 25,200. And as you'll see, that's going to be collected over here in October. We're worried about October, November, and December. 60,000 was the sales in October. I'm not going to get 36,000 of that until next month, so I'm going to move it over here. If I take 60 minus 36, it means that I'm going to collect the 40% of October sales in October, and then I'm going to collect the 60% sales from September in October. So my cash receipts are 49,200. Let's look at December. 84,000 is my sales in December. 50,400 is not going to be collected until over here in January. So I'm going to get my 40% of 84,000 this month. I'm going to get November's accounts receivable this month. So I'm going to collect 62,400. All right, everything I just told you right there. I guess I should have hit spacebar a little bit more often. All right, what about the cash disbursements, paying for expenses? So it says managers use the beginning balance sheet and the direct materials budget prepared earlier to help prepare a schedule of cash disbursements for materials. Our purchases of materials are entirely on account. So when we buy materials, we buy it all on credit, and we're going to pay for all of it the next month. So whatever our material needs were in October, we're going to pay for in November. Whatever our November material needs were, we're going to pay for in December. You can see that here. Here's what it looks like. Here was October's material purchases. I'm not going to pay for them till November, so that's going to be my cash disbursements for material. My cash disbursements for material in November is whatever my material requirement was in November. Those things are just coming straight from the direct materials budget. So with those things, we can prepare the cash budget, but I'm going to tell you right now, we've got to have some more information because there's a lot of stuff that we just haven't discussed. There's a lot of stuff that's not really in those other budgets that are only going to be a part of the cash budget. So we have to have more information, such as what's my beginning cash balance at the beginning of October? Wouldn't it be good to know what September's ending cash balance was? Yes, it would. There it is. $20,000 is what we're going to start October with. None of the other budgets tell us if we plan to pay a cash dividend. That's only going to be on the cash budget. And you see it says continue. There's a lot more to come. It says that TSC has an income tax liability of $20,000 from the previous quarter that's going to be paid in October. That wasn't any part of any other budget. We're going to purchase that $25,000 of equipment in December that we already talked about. Because we don't have a separate budget, we need to deal with it here. We have an agreement with our bank. So here's the whole line of credit issue. We have an agreement with the bank for loans at the end of each month to enable a minimum cash balance of $20,000. In other words, if cash goes below $20,000, we're automatically going to get money from the bank to bring our cash balance up to $20,000. So in October, if we end with 15, the bank's going to automatically push 5,000 into our bank account, and then we're going to have to pay that back at some point just to bring the cash balance up to 20. It looks like we pay interest each month equal to 1% of the prior month's ending loan balance. That's on that line. And we repay loans when the ending cash balance exceeds 20,000. Looks like we owe $10,000 on the loan arrangement at September 30th. It's good to know what we owe at the end of the month. And we have a 40% income tax rate. That's good for financials, and that we're going to pay taxes for the current quarter next year. Doesn't matter for the cash budget, but good to know. All right, don't let this scare you. It's not nearly as scary as it looks. Let's see if we can walk through it. So remember they told us that September ended with 20,000 cash, so that must be what we start October with. And then if we look at that cash receipts budget, remember how we kind of rolled 60% forward and did 40% of the current month? That's our $49,200 to give us total cash available of $69,200. Okay, it's pretty straightforward. Let's just keep watching October. It wants to flip-flop around a little bit, but we'll see if we can kind of keep it on track. And then if we look at the cash disbursements, here we go. This was the disbursements for direct material. Remember when we looked at that and we said that we're going to pay for all of September and October, all of October's in November, and all of November's in December, right? The direct labor was straightforward. It just comes off the direct labor budget. The variable overhead, straightforward. It comes from the overhead budget. Sales commissions was straightforward. Sales salaries was straightforward. And the G&A was straightforward. These all come from those budgets that we created. If you looked back at the additional information, just one slide back, it says that we owed $20,000 of income taxes payable from September, and we were going to pay it in October. I think it's probably going to jump over here real quick, but I'll just tell you, for now that remember that they just said that we were going to pay a cash dividend out. Oh no, I guess it came right on down. They must have fixed it for us. The interest on the bank loan in October. If you looked back at that additional info, it said that we owed $10,000 on our bank line of credit at the end of September, and that we have to pay 1% each month on whatever the prior month's ending balance is. Well, 1% of 10,000 is $100, so we pay the $100. Here's where it jumps over to the $3,000, which I'll talk about in a second. So when we take that $100, we get total cash disbursements. It says that our preliminary cash balance was $25,635. Well, do you remember what it said? Right? Have an agreement with the bank for a minimum cash balance of $20,000, and if it exceeds $20,000, we use any excess to repay loans. Well, what's our excess? It's $5,635. We owed $10,000 to the bank, so we're going to go ahead and pay back that $5,635 to leave us an ending cash balance of $20,000. And now we owe the bank $4,365. Okay, you'll notice if it'll stick with us here that the ending cash balance for October now moves up to November. And I'm just going to walk you through the rest of this without letting the slides do it, so it doesn't get in the way. We'll just walk through November. You can figure out December on your own because it's pretty straightforward. The cash receipts from customers, we had that budget. There's our total cash available. Then our direct material budget, our direct labor budget, our variable overhead budget. So they all just keep coming straight on down. There's the dividends. There's 1% of last month's loan balance as $44. So now I have a preliminary cash balance of $43,246. That's way more, right? I still owe $43.65 on the loan, so I'm going to go ahead and pay it all back, leaving me $38,881. Then I come up and I start December. We do the same thing, and the only thing I had different in December was I was going to buy that piece of equipment for $25,000. Okay? All right. Once we have all of those budgets done, we can create a budgeted income statement. We can do budgeted financial statements, actually, of which the budgeted income statement is going to be one of them. Truth of the matter is that most of our higher-ups in management are really not going to understand all this budget stuff. I will tell you that the cash budget is probably used more from middle management down. They're the ones who have the understanding. The accountants certainly have an understanding of it. So what our top management is going to want us to do is to take our budget and create what we call pro forma financial statements. Pro forma is just a really fancy way of saying a budgeted financial statements. So what does the income statement and the balance sheet look like if we use our budgeted numbers? That's basically what it is. So let's see if we can do it. First, we're going to start with our income statement. This is for all 3 months. So this is for the entire quarter is what we're talking about here. What do we plan to sell? If you went back to the sales budget, the entire quarter we were going to sell 3,200 units at $60 a unit, it's $192,000. Remember when we figured out what the cost of goods sold per unit was? And I told you about that $17, right? We saw a slide back there on that. Well, if we sell 3,200 units at $17 a unit, that's $54,400, and then we can compute our gross profit. So now we take into account all of our expenses. What about sales commissions? We know what those are. Remember the sales commission budget? And then our sales salaries, then our administrative salaries, our interest expense that we got from the cash budget. All of that gets us down to an income before taxes. And if our income tax expense is 40% of that number, which they gave us in the additional information, we now know our net income is $59,254 from a budgeted perspective. We can look at our CEO or COO and we can say, look, if our budget holds true, we're going to be $59,254 to the good. Okay? Can we do a balance sheet? Sure we can. Now they had to give us maybe a little bit more information than we have here completely because there was nowhere else that they told us things like accumulated depreciation, common stock, or retained earnings. But certainly we can figure this out. The $44,706 was from the cash budget. The accounts receivable at the end of December is going to be what? 60% of December sales, right? Raw material inventory, I think we have from the direct material budget. Finished goods inventory, we can calculate from cost of goods sold. They had to give us this information, but certainly we can still work all of this out and now do a budgeted balance sheet as well. So that's the end of master budgets. Again, remember that a master budget is that plan, it's that overview of what things are going to look like in the future to help management make better decisions.